Have you ever taken a taxable lump sum from your pension only to look at what's been paid into your account and think, where did they get this figure from? Like a basic rate taxpayer taking £10,000 before tax, expecting to get £8,000 after tax, and yet they end up with just over 7,000 ish. Now, if you've overpaid tax, you should get this back. But a lot of people are waiting longer than they need to be for that tax to be repaid to them. Some people are probably unsure as to whether they've underpaid, overpaid, or where the hell these figures come from, and they would sooner talk to their mother-in-law than they would do make a phone call to HMRC. Then, to raise hopes, we've had these recent headlines talking about how HMRC are going to end the overtaxation trap and overhaul this scandalous system. Well, I hate to be that guy, but you are still, most likely, going to pay more tax up front than you should do on taxable pension withdrawals. Let's have a look at why that's the case, what's going on, and most importantly, what can you do about it? Hi, my name's Andrew, Chartered Financial Planner based in the UK. At the time of recording, we have made it to 1,000 subscribers. I want to thank everyone who pushed that button and supported the channel along the way. If you're new here and you like this type of content, press the subscribe button for plenty more to come in future. Before we jump into what these headlines are getting at, the recent change that HMRC have announced, I think it would be good to just have a very quick recap of how pensions are taxed. Now, I'll start with the classic defined benefit or final salary schemes. You'll have a one-off point when you take benefits to decide whether you take a tax-free lump sum or not. Some schemes come with an automatic tax-free lump sum. But beyond that, the scheme pension that you get paid typically monthly will be subject to income tax. And with defined contribution pensions, the more common pot-style pensions that we're all seeing now, you can again take some of the pot as tax-free cash, normally a quarter of that, 25%. But anything you receive in income from an annuity, drawdown payments, or if you take your pension as a lump sum, off plus payment or small pot, the 75% of it that's treated as income, any of that income from pensions, again, will be subject to income tax. As of 2024-25, the income tax bands look like this, and I think we know they are not going to be budging anytime soon. Call it fiscal drag if you want to, either way, we're all paying more taxes. Now, the tax bands are cumulative, you work through them, so let's say you were getting a salary of £20,000, you'd have worked through your personal allowance at nil rate, and you'd be into some of that money sitting in the basic rate or 20% band. But then let's say you take a taxable income withdrawal from your pension, probably a lump sum from drawdown, or maybe you're cashing in a pot, and you get £40,000 of gross income, and that will eat up the rest of your basic rate band and leave a little bit sitting in the higher rate band at 40% tax. Now, there are all sorts of horrible complications to our tax system, but I'm not going to dwell on them here. The issue is that what you are actually due to pay in income tax versus the tax amount that your pension provider takes off you before paying out your income payment are often two very different numbers. And the timing of your withdrawal and the amount that you take can influence how wrong that deduction is. When a pension provider pays out your taxable income, they put it through the pay-as-you-earn system, PAYE, which you'll no doubt be familiar with if you've had an employed job and had your pay slips. HMRC fire out tax codes to employers, and they do the same process for pension providers. Now, the tax codes that they fire out are a mixture of letters and numbers, which tells the pay-as-you-earn system, this calculator, what income tax to take off you at source. There's all sorts of these different letters and codes that HMRC can issue to try and get themselves the right amount of tax in from your pensions and employment. You might be familiar with 1257L, the most common, which essentially just gives you the full personal allowance and standard tax bands. But more commonly now, we're also seeing T codes because people's personal allowance has been adjusted, and K codes because your state pension's gone above the personal allowance and you need to pay a bit of tax on it. Or maybe you're still in employment with a decent company car and it's adjusted for something like that.
It's a lovely car, and if you do... I'm not driving a Mini Metro.
If you've ever changed jobs frequently within the same tax year or had multiple employments at the same time, you'll probably be aware that it can get a little bit messy with pay as you earn. HMRC maybe struggle to get the right tax codes to the right people at the right times, and you end up underpaying or overpaying a bit of tax. And in the following tax year, they adjust for this, or maybe you get a rebate at some point. Well, with pensions, particularly when you take your first income payment, the situation can get a little bit messy too. HMRC doesn't really know your pension exists unless you've provided your provider with a P45, which most people either don't do or just don't have one to give them. And it means that the first income payment from your pension will be subject to emergency tax, or in HMRC's language, a month one, week one basis. And if you think of the 1257L as the standard tax code, which would give you the normal tax bands shown here, well, if you are on an emergency month one basis with that M1 tagged onto your tax code, you'll effectively get 1/12 of the tax bands when you take your income payment. So the tax bands then look like this. What it means is that you're going to push through those bands a lot quicker. And let's say you're taking £20,000 before tax. Well, that person on an emergency basis ends up paying about 37% of tax, getting about £12,500 net into their bank account. When if this was their only taxable income for the year, realistically they should have paid about 7.5% tax, got about £18,500 net, meaning they've overpaid tax by just shy of about £6,000. Let me know in the comments whether you've experienced something like this, getting a shock taking money from a pension. So after overtaxing a bunch of pensioners to the tune of about 1.3 billion, HMRC said, yeah, we probably need to make some kind of change here. But what is it that they've actually changed? What are these headlines talking about? Well, pre-April 2025, if you took the first taxable income payment from one of your pensions, you'll have likely had this emergency tax deducted, and this would trigger to HMRC that they need to send your pension provider a tax code, and usually that would land within about 35 days or so. Well, from April 2025, the change is that HMRC will automatically issue a cumulative or standard tax code after the first income payment has been made, taking away that waiting period of roughly a month. Well, there's two reasons why I'm not exactly popping open the champagne at the announcement of this change. One, most people are still going to pay emergency tax on the first income payment that they take from a pension, and that would apply if you had, say, one pension with Aegon, then you take another one with Aviva. The first payment from each of those pensions is still probably going to pay emergency tax. And particularly when it's the first payment and you're a bit nervous and unsure about what's happening, yeah, emergency tax is still likely to be the case. And then, what people probably don't realise is point two, you may still pay more tax than you are due to pay, even if you were on a standard cumulative tax code. To illustrate with an example here, let's use that 1257L standard tax code, and we'll stick with £20,000 as the before tax payment from a drawdown or the taxable bit of an UF plus payment. If we're getting this and we're on the month one emergency tax basis, then from the previous figures, we know we're going to get just over £12,500. But if HMRC were to remove the month one basis, and I take that same £20,000 gross on the 6th of April, the first day of the new tax year, I'll actually still end up with exactly the same 12,622 net payment that I would have done on the emergency basis. Why would that be the case? Well, with the pay as you earn system, having a standard cumulative tax code means that the tax deductions are sensitive to the timing of when you take it. The tax year runs from the 6th of April to the 5th of April in the following year, making the first month of the tax year the 6th of April to the 5th of May. And if I take an income withdrawal in this first month of the tax year, what the pay as you earn system is trying to do is smooth the deductions out over the rest of the tax year. So I effectively end up with 1/12 of the bands, because the system doesn't want you not paying tax in the first month and then suddenly having a load of tax to pay at the end of the tax year. It's trying to smooth that out over the course of the tax year. It expects that if I get £20,000 paid to me, that I'll get that every month for the rest of the tax months. On screen, I've shown some of the net amounts that you would get from taking £20,000 gross with a standard 1257L tax code at different points during the tax year to help illustrate that if you waited till the last month of the tax year, then you would get the 18.5 grand that you would be due if you had no other taxable income from other sources. I often hear people saying, even financial advisors saying to clients, oh, you've had emergency tax, that's the reason you've overpaid. Well, technically, if it's not the first payment, you probably haven't had emergency tax. But that doesn't mean that you've had the right amount of tax deducted regardless. There are people that will get issued with tax codes that take a flat 20 basic rate or 40 higher rate tax from their income withdrawals. But again, that doesn't necessarily mean that you'll pay the right amount of tax. Depending on what you get from other sources, you could still perhaps under or overpay. The pay as you earn system, it's not perfect. Now that we've got pension freedoms and people can take big taxable one off lump sums from their pensions, look, there is really no ideal system. Pay as you earn certainly wasn't really designed or built around this. Overtaxation is still going to be a common thing. Quite frankly, HMRC would rather you overpay and then come to them for a refund than underpay and then have to chase you. So, what can you do about it? Well, the first thing is just have an understanding. Take away some of the mystery so that the amount that arrives in your bank account isn't such a shock. Now, your pension provider will be able to tell you what tax code they're going to process an income payment on. I get that you might ring their helpline and maybe not get the best of information, or they might even tell you the wrong thing. So, I do appreciate it's going to come down to the quality of your pension provider. Some of them supply that information online. Some of them will even tell you what the PAYE deduction is going to be before they make the payment, but not all of them necessarily will do. So if you want to do your own calculations, I've linked in the description to HMRC's own pay-as-you-earn calculator. Now, I use this with clients. I've used it for the figures in today's video, and if you've got the right information, you can get the exact amount that's going to be deducted from your taxable income payment. Now, in terms of input to this calculator, you'll know the gross before tax amount that you're going to instruct. We always instruct on a gross basis. You can't tell your pension provider, I want X amount net. You need to tell them the gross amount. And you'll need to know the tax code it's going to be on. Again, ask the provider. Hopefully they can give this for you. If it's on emergency basis, that's really all you need. You will tick to say that it's month one basis. But if it's not, you'll also need to know how much you've taken from that pension provider in income prior to this, so the gross amount before tax, and the amount of tax that's been deducted. Crucially, it's also important to estimate when that income payment's going to be made. There might be a little bit of a delay from the provider, and as I've said, it's clearly sensitive to which month or which tax month you take the income in. As a few other pointers, if you did get a P45, say you've left a job, you could provide that to your pension provider and they should be able to remove the emergency tax before you take your first payment because they can establish a tax code with HMRC. But as of April 2025, even if you don't have this, you could choose to take a smaller payment. So let's say you take some tax-free cash, you put 20, 30, 40,000 to draw down. Maybe you just take a £100 gross payment to trigger this automatic removal of the emergency tax code. It would at least put you on a cumulative basis. The other thing to keep in mind is if you're going to take regular income payments from drawdown throughout the tax year, well, you will get refunds if you take bigger ad hoc lump sums in the earlier part of the year. So let's say you take a big £20,000 payment in the first tax month and then maybe take £200 a month beyond that. Well, you'll probably find that you get overtaxed initially, but then each month, rather than getting, say, £200 less a bit of tax, you might actually find that you get £300, £400 because you're getting a bit of a rebate for that overpayment. Again, it would be smoothed out over the tax year, so you gradually get this back, and by the end of the tax year, it should reflect what you would normally pay based on that tax code. Or if you are just planning to take that one big ad hoc income payment during the tax year, maybe defer that until the last month of the tax year, that 6th of March to 5th of April window, when you'll get the full benefit of the tax bands if you're on a standard cumulative code. And lastly, if you've overpaid tax to HMRC, sometimes in the thousands of pounds, and you want your rebates sooner than later, I would go to HMRC for the reclaim. There is a process to get this rebate directly to you within the tax year. You can claim online or in paper format if preferred. You just need to supply a little bit of information to HMRC. It is the P55 or P53/P53Z forms to reclaim this. I will do a separate video explaining that in a little bit of detail, so look out for that one coming. But essentially, it gives you the tax back quicker within the tax year. Typically, I'd say about 4 to 6 weeks, depending on how busy HMRC are. In summary, this change from HMRC in April 25 to get rid of emergency tax codes a little bit quicker on pensions, it's welcome, it's nice, but it's not a huge change. People are still probably going to be overtaxed, and the headlines out there have probably overplayed how big of a change this is. Hopefully this information has armed you with what you need to at least be aware of what income tax you might have deducted from your pension, and give you the tools to make some decisions around that. If it's been a benefit, if you wouldn't mind dropping a like, and of course if you're new here, tap that subscribe button for plenty more to come in future. As always, thank you for watching, and I hope to see you again.